Welcome to the lecture from the second lecture from chapter 9. It's not really a lecture, we're going to go over some problems from the end of chapter problems and exercises. So I guess I want to share my screen here first thing, and then let's do a few end of chapter 9 exercises and problems. I just got to go to the right place. I probably won't be able to get through all of the ones I want to do, but I'll try to do as many as possible. This chapter has the most concepts in it of the last 4 chapters that we're discussing this semester. So chapter 9, between 9, 10, 11, and 12. 9 by far has the most just total number of different concepts you have to know. But each concept is relatively simple. I don't think it's the hardest of the 4 chapters in terms of the concepts aren't as hard, but the number of them is the most. Chapter 10 probably has the hardest concepts. So the first one is, let me get rid of this. Let's do this exercise here, exercise 9.1a. And of course, the solutions will be uploaded to Blackboard. So here, this exercise tests your knowledge of how to find the acquisition cost. The idea behind acquisition cost is the definition of acquisition cost is it's all the costs that are necessary to get the asset ready for its intended use. It includes the purchase price, but it also includes other things. Any cost that's necessary to get the asset ready for its intended use is part of the acquisition cost. So here we would have the invoice price, $34,000. Let's just talk through it and then we'll write some. So we'd have the invoice price of $34,000. Then we needed to subtract the discount because we paid within the discount period, so we didn't have to pay $34,000. We paid $33,600. Also, we paid the sales taxes. Also, we paid shipping. We insured the machine while it was in transit to us. We had to pay for the machine to be installed. And let me use this as my mouse here. Where is it? It's not showing up for some reason. We had to pay the installation costs. We had to pay the testing and adjusting costs. Now, repair of damages to the machine caused by firm employees. That's not a cost that's getting the machine ready for its intended use. Prepaid maintenance contract for first year of machine's use. This is some contract we've entered into during the first year. Any maintenance we need to do on the machine to keep it up and running, we've prepaid this amount, but this isn't a cost that's getting the machine ready for its intended use. So we would not add the 750 or the 400. So I guess the calculation of the acquisition cost would be the invoice price minus the cash discount we got. We didn't pay the invoice price. We paid slightly less than that because we got a discount because we paid quickly. Plus the sales tax. Plus the shipping, $260. Plus the insurance while the machine was being shipped to us, $125 in case something happened to it. We must own the machine while it's in transit, otherwise we wouldn't have paid the shipping cost. And if we own it while it's in transit, if anything happens to it while it's in transit, we're responsible. So we insured the machine while it was in transit for $125. We also paid $2,000 of installation costs. And we paid $475 for testing and adjusting. So all these costs were necessary to get the machine ready for its intended use. So by definition, these are the acquisition costs. When you add all that up, you should get $38,460. There we go. Now let me see if I can get this mouse to work. There we go, now it's working. Let's work on this next one. Exercise 9.2a. And this exercise tests your knowledge of how to account for a package purchase. So Tamarack Company purchased a plant from one of its suppliers. They paid $1 million, and that got them the land, the building that's sitting on the land, and the machinery that's inside the building. Tamarack also paid $6,000 in legal fees to negotiate the purchase of the plant. So they have spent $1,006,000 for this plant. The $1 million purchase price plus the $6,000 in legal fees to get the plant to negotiate the purchase. Without the legal fees, we wouldn't have gotten the plant. So we have, these are the costs necessary to get the asset ready for its intended use. So that's the acquisition cost. And the question is, this was paid for the plant, but the plant consists of 3 assets: land, building sitting on the land, and machinery that's inside the building that's sitting on the land. So when we make our journal entry, when we buy this plant, we're going to make a journal entry. We're going to debit land, we're going to debit building, and we're going to debit machinery. We're going to credit cash for $1,006,000. And the question is, what's the debit to land? What's the debit to building? What's the debit to machinery? Is it 1/3, 1/3, 1/3? How do we choose the weights? So when you make a package purchase, that is, you purchase an asset for one amount, and that asset really is 3 assets, you have to decide how much of the amount to allocate to each asset. And the way you do that is you do it based on relative market value, or appraisal value, or assessed value. Those are all synonyms. So what they did was Tamarack Company got an independent appraiser to come in and assess the market value of the land, the market value of the building, and the market value of the machinery. And that's how they're going to allocate the purchase price to each of the 3 assets. So the market value of the 3 assets is $900,000. $126,000 of that $900,000 is the land assessed value. $456,000 of the $900,000 is the building assessed value, and so forth. So we're going to use relative market values. We're going to use not 1/3, 1/3, 1/3, but the ratio that we're going to assign to land is the land's market value relative to the total market value. So 126 over 900. That fraction of the $1,006,000 is going to be assigned to land. The building's market value, relative market value, is $456,000 divided by 900,000. So that's the fraction that we're going to use to allocate the 1,006,000 to the building. So this ratio of 1,006,000 will go to the building, and then finally the rest is going to machinery, 318 over 900, or 318,000 divided by 900,000. It's the same thing as 318 divided by 900. So if we do 126 over 900 multiplied by 1,006,000, that gets this entry right here. That gets the land debit. And that one is 140,840. If we do the building, 456 divided by 900, that's the relative market value of the building. Relative to the total assessed market value, the building was assessed 456 of the 900,000. So we take that ratio, multiply it by our purchase price, our acquisition cost, and we get 509,707. And then for the machinery, we do the 318 divided by 900 multiplied by the 1,006,000. We will get 355,453. So these are the answers. All right. Let's do 9.4a. So January 2nd, 2015, Moser Incorporated bought equipment for 100,000. The equipment was expected to have a $10,000 salvage value at the end of its estimated 6-year useful life, and we're using straight-line depreciation. Before adjusting the accounts for 2019, Moser decided that the useful life of the equipment should be extended by 3 years, and the salvage value they estimated to be $8,000. The salvage value is what they think they could sell the equipment for at the end of its useful life. So what they've done is, partway through the asset's useful life, original useful life, they have extended their estimate of the useful life. And of course, that means the asset's going to last longer, so the salvage value at the end of the useful life will be lower. And so the questions here are how do you account for this sort of a thing. So it says prepare a journal entry to record depreciation expense on the equipment for 2019. Well, let's do something that they don't ask us to do, just to help understand this question even more. So the first thing we'll do A and B, but let's do something else first. Let's prepare a journal entry to record depreciation expense on the equipment for, say, 2015. This same journal entry would be done in 2016, 2017, 2018. And then 2019, it would be different because we make this change. So in 2015, the depreciation is just the, so let's put it up here. The formula you learned last lecture, annual depreciation equals acquisition cost minus salvage value divided by useful life. What was the useful life? 6 years. Originally it was 6 years. So that implies that each year depreciation will be $90,000 divided by 6. What's that? 15,000 a year? So in 2015 we would debit depreciation expense 15,000. At the end of 2015 we would credit accumulated depreciation for 15,000, and we would make this same journal entry in 2016, 2017, 2018, same journal entry, same number, 15,000, 15,000, 15,000. So at the beginning of 2019, if we look at the accumulated depreciation account, T account, what's the balance in it at the beginning of 2019? In 2015, we put 15,000 in it. At the end of 2016, we put 15,000. At the end of 2017, we put 15,000. At the end of 2018, we put 15,000. So the balance at the beginning of 2019, or at the end of 2018, is 15,000 times 4. $60,000 is the balance in the accumulated depreciation account. So the book value of the equipment at beginning of 2019 equals the equipment's acquisition cost minus the balance in the accumulated depreciation account as of the beginning of 2019. So the book value as of the beginning of 2019 is $40,000. We need this information to do part A. What's the journal entry for the depreciation expense in 2019 for the equipment? So here we've had a revising of an estimate. We revised 2 estimates. We revised salvage value estimate and we revised useful life estimate. So annual depreciation expense for 2019 through for 2019 equals acquisition cost minus salvage value, which we've revised from annual depreciation expense in 2019 equals book value at the start of the year minus the revised salvage value. This 32,000 up here, this is our remaining depreciable cost. This is what we have left to depreciate. We originally started with $100,000 to depreciate. As of the beginning of 2019, we've depreciated 60,000 of that 100,000. The book value of the asset is 40,000. So there's 40,000 left to depreciate. But then as of the beginning of 2019, we think that the salvage value is 8,000. So we can sell the equipment for 8,000 at the end of its useful life. So really we only have to depreciate 32,000. So we take the remaining depreciable cost and divide by the remaining useful life. Under our old estimates, at the beginning of 2019, how many years do we have left in the useful life? We would have 2 years left because our old estimate of useful life was 6 and we've done 4. But as of our new estimates, at the beginning of 2019, how many remaining years do we have in the useful life? Not 2, but 5, right? Because we extended the useful life 3 years, if you see right here. Before adjusting the accounts for 2019, Moser decided that the useful life of the equipment should be extended by 3 years. So instead of having a 6-year useful life, it should have a 9-year useful life. So at the beginning of 2019, under our old useful life, we would have 2 years left, but then we add 3 more years on, so we have 5 years left. So this is the formula for the annual depreciation after you've revised your estimates. It's your remaining depreciable cost at the time that you did the revising divided by your remaining useful life from the time you did your revising to the end. So it's 32,000 divided by 5, so 6,400 per year is our depreciation expense for 2019, for 2020, for 2021, for 2022, and for 2023. Right, there's 5 years left. Each of those years, this is the depreciation we recognize. So the journal entry 2019 depreciation is debit depreciation expense for 6,400, credit accumulated depreciation 6,400. So this is part A. Part B, do you see though, to do part A, we had to do this other stuff. For part B, what is the book value of the equipment at the end of 2019? The book value at the beginning of 2019 was $40,000. After recognizing $6,400 of additional depreciation expense during 2019, then the book value at the end of 2019 is just the book value at the beginning of 2019 minus the depreciation expense we recognize in 2019, or 33,600. It's the same thing as taking the original acquisition cost and subtracting the balance in the accumulated depreciation account. Accumulated depreciation account at the beginning of 2019 has 60,000 in it. Then during 2019, we add an additional 6,400. And so at the end of 2019, the balance in the accumulated depreciation account is 66,400. So the book value of the asset, 100,000 minus 66,400 is 33,600. So this is the book value definition, acquisition cost minus the balance in accumulated depreciation. You can also get it by taking book value at the beginning of the year minus the depreciation in that year equals book value at the end of the year. They're equivalent, they give you the same answer. Different calculations, but give you the same answer. Answer is 33,600. Hopefully that made sense. Let's do exercise 9.5a, impairment loss. On July 1st, 2015, Karen Company purchased equipment for $325,000. The estimated useful life was 10 years. Salvage value estimated to be $40,000. Straight line depreciation is used. On July 1st, 2019, economic factors caused the market value of the equipment to decrease to $90,000. On this date, Karen evaluates if the equipment is impaired and estimates the future cash flows relating to the use and the disposal of the equipment to be $195,000. Is the equipment impaired? Yes or no? So to decide if the equipment is impaired, the market value of the equipment on the date that you're doing the deciding is irrelevant. So this second sentence here, actually it's the third sentence. This third sentence, it says on July 1st, 2019, economic factors caused the market value of the equipment to decrease to $90,000. That's irrelevant in deciding whether the equipment is impaired or not. So it's just extra information given to you that you don't need to answer the question. How do you decide if the equipment is impaired or not? You just compare the book value of the equipment as of the date that you're doing the deciding, July 1st, 2019. You compare the book value of the equipment on this date to the cash flows you expect to receive in the future from using and disposing of this equipment. As of that same date. These cash flows that you think you'll get from using and disposing of the equipment, if that is less than what you think the equipment is worth, then the equipment isn't impaired. So if, call this A, call this B. So if A greater than B, the asset is impaired. If A less than or equal to B, asset not impaired. So what's A in this problem and what's B? That's all we got to do. So the book value at 7/1/19 equals the original acquisition cost, which was $325,000, minus the balance in the accumulated depreciation account. What's the balance in the accumulated depreciation account? Well, to find that, we need to first figure out what's the depreciation expense each year. And then also decide how many years have gone by from when we bought the equipment until this date. So the annual depreciation is just the original acquisition cost minus the salvage value divided by the useful life. So every year we should be recognizing $28,500 in depreciation on this piece of equipment. 325 minus 40 is 285. 285 divided by 10 is 28,500 a year. So each year we're debiting depreciation expense for 28,500, crediting accumulated depreciation for 2,500. So if we do a T account for accumulated depreciation, we credited 28,500 in 2015, 28,500 in 2016, 28,500 in 2017, and 28,500 in 2018. The equipment was bought on July 1st, 2015. Maybe I should back up. The 12-month period, July 1st, 2015 through June 30th, 2016. That's the depreciation for that 12-month period. The 12-month period, July 1st, 2016 through June 30th, 2017, that's the depreciation for that 12-month period, and so forth. So this is first year's depreciation, second, third, fourth, So as of July 30th, 2019, as of June 30th, 2019, the balance in accumulated depreciation should be the sum of these four numbers. So 114,000. Therefore, the book value is our original acquisition cost minus the 114,000. The book value as of 7/1/19 equals, what is that, 211? So A is 211. B, what's our future cash flows we're expecting to get out of this piece of equipment over the rest of its useful life, which would be how many years? 6 years. So we've used it 4 and we have 6 left. It told us in the problem that our estimated cash flows are 195,000. So we just compare that to 195,000. If the estimated future cash flows are bigger than the book value, then the asset's not impaired. But if the book value is bigger than the estimated future cash flows, then we're in this case, so the asset is impaired. Answer to part A is impaired. Why? Because the book value of the asset on 7/1/19 is bigger than what we think we're going to get out of the asset going forward. This right here is what we think the asset is worth on our books. This is what we think we're going to get out of using the asset. If what we think it's worth on our books is bigger than what we think we're going to get going forward, then it must not really be worth this much, right? So we need to write it down. So the asset is impaired. Part B, what's the impairment loss? Impairment loss is the difference. We need to recognize this much of an impairment loss. 11,000 plus 5,000 is $16,000 impairment loss. And the question, so that's B. And then C, what's the journal entry to recognize the impairment loss? So there's the amount of the impairment loss. In the journal entry, we debit impairment loss. It's like an expense. It shows up on the income statement under the expense, other expenses and losses section. So 16,000, and then we don't credit the machine, we credit the accumulated depreciation. We just add 16,000 to the accumulated. In effect, that makes the book value of the equipment go down by 16,000, or the machine or whatever. So we credit accumulated depreciation. That's it. Notice we never use the market value in this question. We never use this $90,000 anywhere in any of the calculations. And there's a problem on the homework 9, on your online homework for chapter 9, where it asks about this. And the solution that the problem accepts as correct is an incorrect solution. It has you like doing stuff with this market value, but you don't do anything. It's irrelevant information. So I'll have my business course correct that problem for you guys, so everything will be correct. There's something wrong with the online homework. It's question number 9. It's question number 5 on homework for chapter 9. That's the one that there's a problem on. Anyway, this is how you do impairment losses. What's next? Let's see. How about exercise 9.6a? And this is what I was talking about in the lecture last time. That was very ambiguous, can be ambiguous. So there might be one question on the exam in regards to this sort of a concept. Or revenue versus the capital expenditure. The distinction between the two is sometimes ambiguous. Shriver Company built an addition to its chemical plant. Indicate whether each of the following expenditures related to this addition is a revenue expenditure or capital expenditure. A revenue expenditure, again, should be recorded as an expense. It's a cost we incur just to maintain the asset at its normal working condition. Just maintain it. A capital expenditure, this should be recorded as an asset. So this is a cost we incur to satisfy being a capital expenditure. It has to be a cost that we incur that accomplishes at least one of three things. It only has to accomplish one, but if it accomplishes more than one of these three things, then it's a capital expenditure, at least one. And those three things are, if we go to the PowerPoint presentation from chapter 9, to remind myself, what are those three things? So if the cost extends the useful life of the asset, or if it improves the quality or quantity of the asset's output, or if it reduces the asset's operating costs, reduces your cost to operate the asset, then that cost should be treated as an asset, should be capitalized. You debit that cost to the asset. You debit the cost to equipment or to machine or whatever the asset is. If it's a cost that either extends the useful life of the asset, improves the quality or quantity of the asset's output, or reduces the asset's operating costs, you debit the cost to the asset. You call it an asset. If it's a cost that doesn't do any of those three things, but in contrast, it just maintains the asset's normal working condition, then you debit that cost to an expense, just miscellaneous expense or something. So revenue expenditure is an expense. A capital expenditure, you call the cost an asset. So for each of these costs, we have to identify, should it be treated as an expense or an asset? Shriver's initial application for a building permit was denied by the city as not conforming to environmental standards. Shriver disagreed with the decision and spent $8,000 in attorney's fees to convince the city to reverse its position and issue the permit. This was when they wanted to, if we go back and look, add the addition to the building. They built an addition to its chemical plant. Indicate whether each of the following expenditures related to this addition should be treated as an expense or as an asset. When we wanted to build this addition to the plant, we had to go obtain a building permit from the local city government. We were denied, so we hired an attorney and we paid them $8,000 to help us get this permit. This $8,000 should be treated as an asset. It should be treated as part of the addition on the building, not as an expense, because this cost satisfies one of those three things. Those three things again are, does it extend the useful life of the asset? Well, does it improve the quality or quantity of the asset's output? Does it reduce the asset's operating costs? I think it does all three of those by fiat, by default, because without this cost, without paying this attorney, we're not going to get the building permit. And without the building permit, we can't even build the asset. We can't even build the addition. So A would be, this cost should be treated as an asset, aka a capital expenditure. B, due to unanticipated sandy soil conditions and on the advice of construction engineers, Shriver spent $58,000 to extend the footings for the addition to a greater depth than originally planned. Does this cost simply help the asset just maintain its normal working condition, or does this cost extend the useful life of the asset, improve the quality or quantity of the asset's output, or reduce the asset's operating costs? I think it probably improves the quality of the asset. It probably extends the useful life of the asset. And so I think it would be a capital expenditure. This $58,000 should be debited to the building, not debited to some expense. C, Shriver spent $3,000 to send each of the addition's subcontractors a side of beef as a thank you gift for completing the project on schedule. This is just an expense. This is a revenue expenditure. This cost does not extend the useful life of the addition to the building. It doesn't improve the quality or quantity of the addition's output, and it doesn't reduce the building's operating costs. So this cost, this $3,000, would not be debited to building, it'd be debited to expense. Shriver invited the mayor to a ribbon cutting ceremony to open the plant addition. Shriver spent $40 to purchase the ribbon and scissors. Again, revenue expenditure. This problem actually is pretty easy. The costs they're giving us to decide between whether they're revenue or capital expenditures are not ambiguous at all. It's clearly one or the other. So on the exam, I'll give you ones like this one that are very clearly either a capital expenditure or a revenue expenditure. Shriver spent $4,100 to have the company logo sandblasted into the concrete above the entrance to the addition. This one might be a little ambiguous. Does this company logo that was sandblasted into the concrete, does it do one of these three things? Does it extend the useful life of the building? I don't think it does. Does it improve the quality or the quantity of the asset's output? I don't think it improves the quality of the assets of the building's output, but it may improve the quantity of the building's output. The idea is advertising. If more people see the company logo, the more people know what the company is, maybe they're going to get more customers. And if you have more customers, you're going to make more products. The quantity of your output is going to go up. So I would argue that it does improve the quantity of the assets of the building's output. And then the final thing, does this logo reduce the building's operating costs? I don't necessarily know how that would have any effect on reducing the operating costs of the building. So it doesn't do that, but it does the second one though. It does improve the quantity of the building's output. So I would call it a capital expenditure, but it's a little ambiguous. I'm just going to say advertising. It's kind of like advertising when you put the company logo on your building. Because if you don't have a logo there, nobody knows what the company is when it goes by. Well, I guess you could know if you look up in the yellow pages or something, but more people know what it is definitely if you have the logo on. Improves awareness, which presumably improves the quantity of output. And that's one of those characteristics that a capital expenditure satisfies or should satisfy. All right, let's move on and do another one. Let's see, what do we want to do? Let's do problem 9.3a. Getting into depreciation. Let's jump all the way ahead to depreciation methods. On January 2nd, 2018, Schuyler purchased a laser cutting machine to be used in the fabrication of a part for one of its key products. The machine cost $120,000 and its estimated useful life was 4 years or 920,000 cuttings, after which it could be sold for $5,000. And then what we need to do is calculate each year's depreciation expense under each of the following depreciation methods, and so forth. So let's do this. Part A, what's the depreciation expense for each of these 4 years? It looks like 18, 19, 20, and 21 under the straight line method. So A, part 1, straight line annual depreciation equals initial acquisition cost minus salvage value. So 120,000 minus 5,000 divide by 4. So 115,000 divided by 4. $28,750 per year. 2018 through 2021. The same amount each of those 4 years. Number 2, if we use the double declining balance method, what's the depreciation expense for each of these 4 years? Well, the formula for double declining balance method is annual depreciation equals, you take the book value at beginning of year and you multiply that by the double declining balance rate. So that's the formula. And let's make a table. With the Ddb method, it's most helpful to make a table. And what will that table look like? It's going to have 6 columns, and the number of rows will be how many ever years the asset has useful life. So in this case, 4. That's the maximum number of rows. So we're going to have year of useful life, first column, acquisition cost, second column, and I believe I misspelled acquisition earlier, did I? Yikes, that's not good. No, I didn't misspell it. Never mind. Give myself more credit. Oh gosh, we've lost a page. These are the answers to a previous problem. I don't know what happened. Anyway, we went through it. You guys, I think, get what's going on. So I'm going to get rid of this. All right. First column, year of useful life. Second column, acquisition cost. Third column, the beginning accumulated depreciation. In other words, the balance and accumulated depreciation at the beginning of whatever year we're talking about. And the beginning book value is the next column. Beginning book value. And then the Ddb rate, which that doesn't change. That's always the same. And then finally, the last column is the annual depreciation expense, which is what we're trying to get, right? For part A, this is the depreciation expense each year for each of these 4 years. For part 1, A, part 1. For part 2, these annual depreciation expense numbers are going to vary. They're going to be different. They're not going to be the same every year. They're going to be greater in the early years and smaller in the later years of the useful life. That's why they call it a declining balance method. So year 1, the acquisition cost is 120,000. At the beginning of year 1, accumulated depreciation has a balance of 0, so we'll just put nothing there. The book value, therefore, at the beginning of year 1 is 120,000. We haven't depreciated it yet. The DDB rate, all right, what's the formula for DDB rate? DDB rate formula is the number 1 divided by the useful life times 2. So this is the straight line rate. When we multiply it by 2, we get the double straight line rate, or the double declining balance rate. So this is the straight line rate, 1 over the useful life. The DDB rate here is 1 over 4 times 2, or 0.5, or 50%. So the depreciation expense in year 1, 50% times beginning book value, right? Here's the formula. So we're going to take column 4 times column 5 to get column 6. $60,000 of depreciation expense in year 1. Moving to year 2, acquisition cost hasn't changed. The beginning accumulated depreciation is $60,000, right? Because we recognize depreciation of $60,000 in year 1. So at the beginning of year 2, we have $60,000 in our accumulated depreciation account. Beginning book value in year 2 is our beginning book value in year 1 minus the beginning accumulated depreciation. As of the beginning of year, no, the beginning book value in year 2 is our acquisition cost minus the balance in accumulated depreciation at the beginning of year 2. So column 4 is column 2 minus column 3. And then we take 60,000 times 50%, it's 30,000. Now keep in mind, we can never depreciate the asset below its salvage value. So as long as our book value doesn't get below salvage value, we're okay. Year 3, beginning accumulated depreciation. Well, it was 60,000 at the beginning of year 2. And then during year 2, we recognized 30,000 of depreciation expense. So at the beginning of year 3, we have 90,000 in our accumulated depreciation account. Book value at the beginning of year 3, therefore, is 30,000. Multiply by 50%, we get 15,000 of depreciation in year 3. Whoops. Year 4, so I guess this is 2018, 2019, 2020, 2021. Beginning accumulated depreciation at the beginning of 2021. Well, it would be whatever it was at the beginning of 2020, 90,000, plus the depreciation we recognized during 2020, 15,000. So it would have 105,000. Book value at the beginning of 2021, 120 minus 105. And the depreciation expense in 2021, $7,500. And since we haven't reached the asset's salvage value yet, we keep depreciating. Even though we estimate it to have a 4-year useful life. If at the end of 4 years, we haven't depreciated the asset down to the salvage value yet. We keep depreciating it until we depreciate it down to salvage value. So under the Ddb method, we would also recognize depreciation expense in 2022. Under the Straightline method, we would only recognize it in up through 2021, because at the end of 2021, the book value of the asset would be equal to the salvage value, $5,000, by construction, by the way we've constructed it. All right. $120,000. Beginning of year 5, the accumulated depreciation is $105,000. Beginning of year 4, plus the depreciation during the year 4. So it would have $112,500 in it. The 105 plus the 7,500. Book value at the beginning of year 5 looks to be 7,500. And if we multiply 7,500 by 50%, that gives us what? 3,750. Uh-oh, we may have depreciated too much though. So just blindly applying the Ddb method, this would be the depreciation expense in year 5, 2022. But if that is the depreciation expense, when we move to year 6, 2023, what happens? What's our beginning accumulated depreciation in year 6? It's the 112,500 plus 3,750, or 116,250. And what's our beginning book value in year 6? Is it less than the salvage value? As long as this column is greater than or equal to salvage value, we're fine. But as soon as this column goes below salvage value, we've messed up. You can't depreciate below salvage value, which just means the book value of the asset can never be lower than the salvage value. And so the book value of the asset at the beginning of year 6 would be how much? 120 minus 116,250. Would it be lower than 5,000? Yes, it would be 3,750. That's less than 5,000. So we made a mistake. We recognized too much depreciation in year 5. We can't recognize 3,750. We have to recognize an amount, we'll call it question mark, such that when we add that amount to our balance and accumulated depreciation, we get a number that equals 115,000. Why? Because that way our book value will be exactly equal to our salvage value. Then we're done depreciating. So what does that question mark need to be? If you think about it, something plus 112,500 equals 115,000. What is that something? It's 2,500. At the beginning of 2022, accumulated depreciation has a balance of 112,500. If we recognize $2,500 of depreciation during 2022, then at the end of 2022, the balance in our accumulated depreciation account, or at the beginning of 2023, it's the same moment in time, is 115,000. And our book value is equal to the salvage value, and we're done depreciating the asset. So there's no depreciation recognized in 2023, year 6. There's only depreciation recognized in 2018 through 2022. So we can remove this last row. We only created that row to figure out what this number needs to be. Hopefully you guys understand that. So here are the depreciation expense numbers under the Ddb method. 2018, 2019, 2020, 2021, 2022. Notice they decline as time goes by. If we plot time on the x-axis, plot those 5 years, and on the y-axis we plot the dollars of depreciation expense. We plot 60,000, that's somewhere up here, then 30,000 is half of that, somewhere down here, 15,000 is half of that, 7,500, 2,500, declining over time. In part 1, the depreciation expense under the Straightline method is the same amount, this amount, 28,750, for each of these 4 years. If we plot that against time, so we have 2018, 2019, 2020, and 2021, $28,750 every year, that's just a straight line. It'd be looking something like right about here. So straight line method, Ddb method. If we plot, question doesn't ask us to do that. It just asks for, this 28,750 number and then these numbers for the Ddb method. These numbers right here. All right, let's do part B. Part B, no, let's do part 3 of part A. We haven't gotten to B yet. So part 3, this is units of production method, right? Units of production. Assume annual production in cuttings of 200,000, 350,000, 260,000, and 110,000. Those are the actual number of cuttings they did in each of the 4 years. 2018, they did 200,000 cuttings. 2019, they did 350,000 cuttings, and so forth. So with units of production method, it's similar to kind of a straight line type of thing, but things are going to change. The depreciation expense each year is going to be different because we use the machine a different amount. So with units of production method, it's different than the first 2 methods based on one thing. The first 2 methods, straight line and Ddb, they calculate depreciation based on time, whereas units of production calculates depreciation based on use of the asset, not how old is the asset, just temporarily how much time it's been around, but how much have we used it. So it can be a more accurate measure of the deterioration of an asset if you feel that an asset deteriorates based on use rather than time, which most assets do based on use. So to find the, with units of production, we need to calculate the depreciation per unit, which in this example, what are the units? Cuttings per unit of use, per unit of use. If it was a vehicle, the units of use would probably be miles driven. If it's a machine, the units of use could be number of hours the machine was used, number of cuttings the machine did. In this case, it's number of cuttings. So the depreciation per unit of use, in this case, it's the acquisition cost minus the salvage value, just like the straight line method, but now instead of dividing by units of time, we divide by units of use. And what did they estimate the useful life to be in terms of use? 920,000 cuttings. So the depreciation per unit per cutting is 12.5 cents. And so in 2018, the depreciation expense is equal to the actual number of cuttings that happened in 2018 multiplied by the depreciation per cutting. How many cuttings happened in 2018? Well, it told us Assume annual production in cuttings of 200,000 for 2018. So that means the depreciation expense recognized in 2018 is $25,000. 2019, it would be 350,000 cuttings multiplied by the depreciation per cutting gives $43,750. 2020, 260,000 cuttings times the depreciation per cutting, and you get $32,500. This is a 5, not a 9. I'm getting sloppy in my writing. Apologize for that. And then finally in 2021, the actual cuttings were 110,000. And we have a depreciation per cutting rate of 12.5 cents. So the depreciation in dollars that we would recognize in 2021, is $13,750. And that gets it down to its salvage value. Notice the sum of these numbers. The total depreciation expense recognized over the 4 years, $115,000 under the units of production method. Under the double declining balance method, total depreciation in this case recognized over 5 years, $115,000. And under the straight line method, the total depreciation expense recognized in this case over 4 years, if you do 28,750 each year times 4, $115,000. So it doesn't matter what method you use over the asset's useful life, that's the total depreciation expense will be the same. But what differs is how much what's the depreciation expense each year? That's what differs. All right, let's move on to part B. Actually, we're not going to do B. B is just like, it's just repeat A, but assume some slightly different assumptions. Well, I guess we can do it because it's, it says assume the machine was purchased July 1st, 2018, instead of at the beginning of January 2018. Fine. All that this is going to test is, can you do, half year depreciation? So we'll go and we'll look at it. So depreciation expense, straight line method, 2018 through 2022, right? Because we got to go through July 30th, 2022. Year 1 is July 1st, 2018 to July 30th, 2019. Year 2 is July 1st, 2019 through July 30th, 2020, so forth. Year 4, July 1st, 2021 through July 30th, 2022. Again, we would do annual depreciation is equal, under the straight line method, acquisition cost minus salvage value, divide by useful life. We're going to get our 28,000. We're going to get the same number we got up here, 28,750 per year, because it's the same calculation. Per 12-month period, that's the depreciation. However, 2018 depreciation, only half of 2018 like, we didn't have the asset in January. We had it as early as July 1st. So we only have to recognize half of a year for 2018. July 1st, 2018 through December 31st, 2018. So we would take, this would be the amount we would recognize if we had the asset for all 12 months of 2018. But if we only have the asset 6 months of 6 out of the 12 months for 2018, July through December, then we have to multiply this by 6 over 12, or 1/2. So what would that be? 14,375. For 2019, it would be the 28,750 for all 12 months. For 2020, it'd be the 28,750. All 12 months, because we had the asset all 12 months. 2021, again, 28,750. And then finally, 2022. In 2022, do we have the asset all 12 months? Well, the useful life of the asset ends, we are assumed to have sold it on June 30th, 2022. That would be 4 years after we bought it. So we actually only have the asset in 2022 for 6 months. So again, we would take the 12-month depreciation times 6 over 12. And this is for the period 1/1/22 through June 30th, 22. And this was for the period 7/1/18 through December 31st, 18. Hopefully that makes sense. And then finally, part 2, do the Ddb method. We could set up our table again. Let's do this. Copy. I think I copied it. Actually, I don't think I copied it. Let's go back. Do this, copy, copy, and then come over here and paste it, and then I'll erase the things that we don't need. Actually, I'm going to paste here. All right. Can keep all of this. So in 2018, that's year 1 of the asset's useful life. But again, we got the asset on July 1st, 2018. So this 60,000 is the right amount if we had got the asset January 1st, 2018. But half of that is the right amount for, for half of the year. So we would actually multiply this by 6 over 12 to get to 30,000. I could add another column in here, like part of year or something, but you guys realize in 2018 we got to multiply by 6 over 12 because we only had the asset half of the year. So that's why that's 30,000. But that changes the other numbers because now the balance in accumulated depreciation is going to change, right? So what's the balance in accumulated depreciation at the beginning of 2019? It's 30, not 60. So what's the book value at the beginning of 2019? It's 90, not 60. So what's the depreciation during 2019 for the whole year, for all 12 months? 45,000, right? These numbers are all going to change. This is going to change. This is going to change. All right, what's the balance in accumulated depreciation at the beginning of 2020? Well, it was 30 at the beginning of 2019, and during 2019 we put 45,000 in it. So now it has 75,000. What's the book value at the beginning of 2020? 120 minus 75, 55. What's 55,000 times the DDB rate? 22,500 is the depreciation recognized during 2020. 2021, what's the beginning accumulated depreciation? 97,500, right? What's the book value at the beginning of 2021? It looks to be 22,500. 22,500 times the DDB rate, 11,250. So 11,250 is what we recognize in 2021. Now in 2022, remember we only have the asset 5 months in 2022, or 6 months in 2022. Beginning book value, beginning accumulated depreciation, 2022 would be 97,500 plus 11,250. It'd be what would that be? 108, 750. Is that right? 97 plus 11 is 108. 500 and 250 is 750. Yeah. And so the beginning book value in 2022 is 120 minus 108, 750, 11,250. And 11,250 times 50% would be what? It'd be 6,500 is half of 11,000. No, 5,500 is half of 11,000. And let me just get my calculator, make sure I do it right. 11,250 times 50%. 56.25. But here, well, if we do that much depreciation, we don't get the how to say this. If I said I need to put here 7/1/22. This is the beginning of 2022. Here is January 1st, and let's say this is not year 6, it's still year 5. But as of 7/1/2022, if we went ahead and kept doing this, beginning accumulated depreciation would be 108, 750 plus 56.25, 114,375. And so book value would still be slightly bigger than salvage value, right? It would be 5,625, still slightly bigger than salvage. It's still bigger than 5,000. So we could still depreciate. We wouldn't depreciate it the entire 50% though, because that would take our book value to be lower than salvage value. And so rather than do that, we need an extra $6,025 of depreciation. You see that? We need an extra $625 to get our book value down to where our book value will equal our salvage value. So if we just add that extra $625 to this number, then that'll get us the right number here. So 5625 plus 625. What is that? $6,250. And so that's what we recognize in 2022 under the Ddb method in relation to this asset. Why that amount? Because that's the amount that gets our beginning book value right after this, right after doing this. Then our book value will equal our salvage value. Hopefully that makes sense. This is like a plug. So you could say the amount needed to make book value equals salvage value. So hopefully that makes sense. So these are the numbers under the Ddb method. This much for 2018, this much for 2019, this much for 2020, this much for 2021, and this much for 2022. And under the Straightline method, these are the numbers for 2018, 2019, 2020, 2021, and 2022. All we did is change the date. We got the asset not at the beginning of the year, but sometime in the middle of the year, sometime in the year. It didn't have to be right in the middle like it was in this one. In this case, it was July 1st. It could be March 15th. It could be any date, and that's going to change the calculation slightly because you have to account for partial years. Anyway, those are the problems that I wanted to work. I think this lecture has gotten long enough. I think it's about an hour and 20 minutes long now. And I believe that's about enough. That's all I want to do. So hopefully you guys understand how to do some of these problems and these concepts. And I'll see you guys in the next one.